Hello, I am Astrid Schmulian and with me today is Stephen Kutsia. We are both lecturers on an introductory course to IFRS and this is an IFRS for Rookies presentation.
The purpose of this presentation is to provide you with a brief overview of IAS 40 investment property. As this presentation is intended for IFRS rookies, we will not consider transfers to or from investment property. Neither will we consider the interrelationship of IAS 40 and IAS 17 leases. The initial step in the accounting process is the identification of an economic event on which to report. This process then concludes with reporting on that event. Accordingly, a typical IFRS reflects this process in its structure, while basing its principles and rules on underlying concepts. In the instance of IAS 40, the economic event considered is transactions involving investment properties, and it may be argued that the 1989 framework provides the underlying concepts. It is of interest to note the change in conceptual thinking underlying asset accounting. Inventories, one of the older asset standards, relied heavily on prudence, while a shift to neutrality is noticeable in IAS 40.
Investment property is defined in IAS 40 and differs from owner-occupied property as well as property held for trading purposes. As investment property is a non-current asset on a statement of financial position, the concept underlying the definition of investment property is the asset element definition, as contained in the framework on which the investment property standard is based. Guidance is provided in the standard on how to determine the correct classification and consequent recognition, measurement and disclosure where property is held for a dual purpose as owner-occupied and as investment. Further guidance is also provided where the lessor provides services to the lessee. Where property meets the definition in IAS 40, it is initially recognized when the recognition criteria is met. All initial or subsequent amounts incurred are evaluated against this recognition criteria, which is in line with the criteria put forward in the framework. Rules are provided for some situations where this evaluation of the recognition criteria might be problematic. Initial measurement of investment property is at cost, whilst a choice between cost model and fair value model exists for subsequent measurement. The fair value model is more aligned with the neutrality concept in the framework than the cost model. Specific rules are provided in the standard for the inclusion of amounts in or the exclusion of amounts from the original cost that is recognized. If the cost model is chosen for subsequent measurement, IAS 40 refers you back to the cost model in IAS 16, and the accounting treatment of the investment property is then equal to that of property in terms of IAS 16. If the fair value model is chosen for subsequent measurement, the investment property has to be measured at its fair value at the end of each financial year. All fair value adjustments, upwards or downwards, are recognized in profit or loss. Specific exceptions, where the fair value for an investment property cannot be determined, are addressed in the standard. A change in accounting policy from the cost model to the fair value model is dealt with in terms of IAS 8. Investment property, being an asset, is derecognized when no future economic benefits are expected from that investment property, as the asset definition is then no longer met.
Investment property is presented in the statements of financial position and supported by detailed disclosure in the notes. While not specifically addressed by IAS 40, one should not ignore the cash flow implications associated with investment property transactions.
We hope you enjoyed this IFRS for Rookies presentation and look forward to engaging with you on Facebook.